Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Sell in May and go away, or stay in May and make some hay? We're going to talk about that in a minute. I mean, everybody talks about selling May, and yeah, we had a tough day yesterday, except for NVIDIA as a one-stock wonder yesterday. But other than that, May's been pretty damn good. So now, according to Bill O'Neill, it didn't matter if it was sell in May and go away. If it was an FTD, a follow-through day, it's time to buy. So even if it's a narrow market, as long as you're in the narrow, it's okay. And speaking of IBD and some other periodicals, we're going to talk about potential conflicts because it's your money, not their money. And therefore, there's some certain you must do. And we'll talk about that to make sure you're getting buy-side research, not sell-side research. And before I forget, I want to remember it's a 3-day weekend. It's a Memorial Day Monday. Remember the fallen. They gave all so that we could have the freedoms to do the things we can in this country. So that's very important. Okay, so let's get right down to it. You hear these bears just saying it's time to get out. Everything's going to hell in a handbasket. And then you have people on the bullish side saying, man, we're setting up. Even some guys in IBD are talking about a power run. What's it called, Don? There's a term.
Power trend.
Power trend. It's a power trend, and we're just at the beginning of it, and it may be a rip, snort, and rally. Well, gosh, aren't you a little scared at these fundamental valuations? How do you get in at these valuations? Ooh, it's kind of, if you have a sell discipline, it makes it a lot more palatable and a lot more easy. However, so I'm going to go to a few little tidbits right here, a few fundamentals. Okay, the Philly Fed Index, the diffusion index, which measures general economic activity, declined 11 points in May. New orders declined from 12.2 to negative 7.9, the first drop since February. Shipments fell from 19.1 down to negative 1.2. Industrial production was flat, and factory output fell month over month by 0.3%. The Conference Board of Leading Economic Indicators, the LEI, that means forward-looking. Those are usually the better indicators to look at. Decreased 0.6% in April after a decrease of 0.3% in March, so almost 1% in 2 months. So if the leading indicators are slowing down, coupled with the money supply, the M2 money supply shrinking, meaning tighter money, right? And the Fed saying they're going to decrease their balance sheet. I'm not holding my breath on that one. But anyway, the Fed saying they're decreasing their balance sheet. All that taken together, you stir that up in a pot, it means it's weakness in the economy. But the markets are showing strength. Now, how are you really going to know? So all these kind of point to a slowdown, not necessarily recession. How do you know technically whether that recession is starting or it's showing up in the markets? If it's showing up in price, remember price is truth, because yield spreads will widen. High yield will separate from investment grade or treasuries, and financial conditions will tighten. So you got to look for a liquidity event, which is the main thing. Now, whether it's inflation or not is going to determine whether the Fed becomes more accommodative. So in any event, those are things to look at. Now, Ed Yardeni came up with he did an article, and all these are in the show notes. You can read all these. And he's talking about here are the risks to watch for. He said the Fed is no longer significant risk. They're not going to continue tightening. They're probably not going to lower, but we can go higher at these rates. He said the real risks are the credit crunch, a liquidity crunch like I was talking about, geopolitical risk. Obviously, I don't have to go into that. And the wild card is a presidential election. Now, the three scenarios for the next 2 years, in his opinion. Okay. The three the market can continue, and it can be a melt up. What would trigger a melt up? He said people on the sidelines, fear of missing out, they're going to start buying in if it keeps going up, right? And he said the Fed, and he doesn't want the Fed to cut rates. He said they're already fine where they are. In fact, these are normal rates. That's what I've been saying. He said the anomaly was zero interest rates. His targets are 5,400 by the end of this year. For next year, he's looking at 6,000, and the year after that at 6,500. That doesn't mean anything to me because 2 years out is too hard to look at. Now, the risk factors are that profit margins, revenues, and everything could get depressed. But he said the Fed is no longer the biggest risk. Credit crunch, geopolitical, but he's talking about the most likely scenarios. 60% probability of the roaring 2000s, roaring 20s. So he's saying he's 60% probability you're gonna have a strong market. There's a 20% probability of a 1990s melt up where it just kind of melts up. It's not a big rally. And then 20% probability of a replay of the 1970s, AKA stagflation. That's what I'm a little more concerned about. I would probably raise that a little bit, but I think the economic outlook is a little bit worse than he thinks. Now.
Great. So what happens, he can say he was right.
Yeah,
See, I told you there's a 20% chance of it.
Yeah. No, he definitely is hedging a little bit. That's okay. Now, here's one thing I'd like to point out because the market has been rallying, and the market is a forward-looking about 9 months. Just maybe the markets are forecasting a presidential win for Trump, and they think that they like those policies better. Whether you like Trump or not, I don't care about that. I'm just saying his policies are going to be more business friendly, and maybe the market's rallying because of that. Who knows? Who cares? It really doesn't matter to us at Revere. At Revere, price is truth, and we're going to make adjustments accordingly. Now, I was talking about a couple of articles in the mailbag that you guys can go look at. I'm not going to grind the show to a halt. AI controls and, do we need regulations for that? The EU's taking a very active role. What do we need to do? A surge in retirement spending for couples that when couples retire together, they don't spend as much. But when one retires first and then the other one's still working, it was an interesting study. Sometimes they actually have an increase in spending. T1 trade date +1 settlement starts Tuesday. Be ready. And then the worst and best broker dealers for 2024. You can go look at that. But I did get a couple things in the mailbag, and I want to talk about this because this is going to kind of set up what I was talking about. It's your money, not their money, and so you must. You always have to look at who writes the articles or their advertisers, okay? So this is from a listener, and he's a big diehard IBD guy. He said, Dan, not sure you read the IBD weekly paper, but thought you might want to see their financial planning advice. I'm guessing Bill O'Neill is rolling over in his grave. They're preparing on this article, preparing for retirement. It looks like it appears to have written by, quote, a pie chart pithead. His words, not mine. Remind the editors Bill's sell-side discipline and offer to write a counter article. Let them know that Revere offers a truly fiduciary approach and little need for hand-holding. Basically, the article said that the reason you'd have an advisor is to have them hold your hand during market downturns and to stay the course. It was kind of an asset allocation pie chart article, which surprised him. And I said, thank you for sending. I said, they are conflicted now because they're owned by Dow Jones, and Dow Jones tentacles are very deep and wide, and they own and have owned indices and other type of investment research and advice. And so he says, there's the answer. I'm guessing many long-term IBD subscribers, myself included, have no clue how the Dow purchase put Bill O'Neill on the sidelines. Thanks for the explanation. Now, folks, IBD is still wonderful. It's a wonderful product. We use Market Surge all the time. But here's what and even when Bill was around, even IBD, they did have advertisers. You could pay to advertise on IBD's newspaper. So sometimes you would get an advertisement from an annuity, Income for Life, or from a mutual fund or an ETF provider or some kind of other people in the investment world. Look, active management is hard. It's not easy. But they've always had articles. But now that Dow Jones owned them, there's going to be some cross-pollination. Dow Jones is going to be trying to put in the IBD paper some of their articles that satisfy some of their big advertisers or some of their other products, not just IBD. Hopefully, though, some of the IBD ideas, the buy side only and the active management, actually filter and go through to the other sides of Dow Jones and the other aspects of their company. So it is acceptable. But all I'm saying is when you read the articles, any article, whether it's IBD or anywhere, always remember that you've got to go back and look at the source. Stansberry Research is one of the, look, Stansberry Research they've got their penny stock guide that if you buy this stock in pennies and you hold it, you put in $10,000 and like Amazon, you would have had 24 million today, or the penny stock guy, the next big thing. Or they've got their perma bear, doom and gloomer, no matter what, he always writes a negative bear. The next big stock, this dividend strategy, you can just set it and forget it. They've got every different genre so that when you go read Stansberry, your emotional makeup, you're gonna latch on to something that agrees with your emotional makeup. And so no matter what, Stansberry's got something for you. I'm not saying it works. I'm just saying that's the way it is, and that's the way those big aggregators, and the bigger they get, the more different things that they're going to throw in there. So the secret is you got to extract the baby from the bathwater so you don't throw the baby out with the bathwater. You're just throwing the dirty bathwater out. Okay? So that was a good article. Thanks for sending. And then this one is the next mailbag, and this actually leads directly what we're going to talk about in the markets today. So basically what I was telling you was with IBD owned by Dow now, and with Stansberry Research, and with a lot of these other players, a lot of their research is sell-side research, meaning the ETFs, the annuities, the mutual funds, they're trying to sell you a product. Buy-side research, on the other hand, only represents the investor, and it's free of conflicts of interest. So it's information on how to select stocks or what the best ETF or mutual fund is. What should you actually buy that is cost benefit for you? And so with that, this next mailbag is, hey, Dan, now this is the day before NVIDIA is about to announce earnings yesterday, which, as you know, they blew them out again. Hey, Dan, thoughts on buying NVIDIA stock on margin today? Sounds like earnings could be huge. Thanks, CW. He's a client also. CW, that is a risky move that could go either way. You either hit a grand slam in the bottom of the ninth or strike out. Earnings are a binary event, right or wrong, period. And I want odds more in my favor, not a coin toss. Those earnings numbers you're referring to are already priced in the stock. It is not that NVIDIA has to beat earnings. They have to blow them out and beat the whisper number expectations. Thus, NVIDIA has to be better than the expected move, which is already priced in, or it will sell off, even if it beats. Now, while NVIDIA currently is the leading stock in the market, like I said, it could get hammered if it disappoints, and we don't gamble Vegas style, which is what going on margin would be doing. He wanted to go on margin and borrow to do this. I said, that's akin to Vegas. You have to beat the bookie spread to win. So it's not that your team has to win. You have to be more right than the spread. I said, all that said, NVIDIA is, however, your second biggest stock position, and if it beats, you will benefit nicely. If it has a big move higher, we have to be okay with that. We made nice profits, even though we wish, in hindsight, that we had more. If it does meet, Monday morning quarterbacking is common in investing, but it only leads to poor decision making in the future due to biased beliefs. In other words, you got to let it go. You got to be okay with it went up without me a little bit. I could have had more because it's still a risky move. Remember, we, and I think you, would rather be stuck out wishing we were in than in wishing we were out. Folks, the market, there's too many times it's easy to make money that you don't have to take big bets or try to make money when the market's struggling. You can miss out on some things. We may miss out on a few big moves, but we will not have a big move down. This is why we manage position sizing around earnings events so meticulously. Don goes over this in his nightly videos, and if you're interested in learning how the sausage is made and the actual mechanics of buy, sells, and position sizing, watch Don's videos. Hope this helps, and it was a complete answer. He says, CW, thanks for the insight, Dan, and thanks for bringing me back to reality. Folks, we actually had a couple other clients that one was buying a house and they had to take out a big chunk of money for a down payment. So their position size wasn't 6-7%, our normal NVIDIA, our full NVIDIA size that we had for everybody. It was much larger. It was mid double digit, 14% or so. We had another guy that just did unfortunately divorced, split some money out. He also had a disproportionate position in NVIDIA. So we had two clients that were unusually large because they took money out this last week. Now, normally we just take care of clients and we just manage it for them. However, in this situation, NVIDIA is our favorite stock, and we can either partially hedge that position or trim some down. They both happen to be in taxable accounts, and these people had big gains. I called them, now this is unusual, but I called them up both and said, I want to bring you in this decision because this is not a normal thing where we just do it automatically and everybody's assimilated to the same protection portfolio. What would you like to do? I personally, a little more aggressive, I would hold and sit through it because even if NVIDIA does disappoint and gets hit, it is the groupie stock right now. It's like Apple was 10 years ago or Tesla was 4 or 5 years ago. It's not now, right? NVIDIA is the stock, and if it does have a pullback, everybody's looking to buy in. So the risks are a little bit, not as much, I think. The whole point is I brought them into that decision. I asked them, and both of them said, you know what? I think I'm willing to take that risk. I'm willing to let it ride. They were happy they did. Okay. Now, going on margin to do it, borrowing to do it, that's a different story. That's very risky. So in any event, you always just want to know your risk and managing your risk side. So we're about to go to the markets, and Don's going to go over that. But before we do, then this is a related note because, like I said, Revere only represents the buy side, you, the client. We don't deal with any sell side stuff, but there are some periodicals, news broker, to anybody that have kind of a mix, and you got to be able to decipher through what is actually kind of slanted or written in a way to try to sell you something and what is pure unfiltered data and facts you can use to help you with your investments. Now, so on this related note, that's why we at Revere came up with what we think is a brilliant idea. And of course, now we must be suspect of our idea. And so we want confirmation. So we're actually going to get some Revere asset t-shirts. This nice golf shirt, but it's going to be a t-shirt, and it's going to have some clever logos or slogans actually that kind of represent the buy side only. Okay. You will never hear any sell side stuff from us. Okay. Now, we've already come up with a few that we're thinking about doing. But if you've got some ideas and you want to email me, dan@revereasset.com, and give me your idea, and we use your shirt, your idea, your slogan, we'll actually send you a shirt for free. Okay, now, one that's already taken, got stops? That's one. Like got milk, got stops? What's your sell discipline? Yeah, it's kind of lukewarm on that. What's in your portfolio? I like that one. You remember the E-Baby? The E-Trade baby? Think about a little 5-year-old, 6-year-old kid walking around with what's in your portfolio t-shirt. This one's a little bit racier. I'll show you my portfolio if you show me yours. Show me your assets. And this one is very, very, I'm not going to do that one. That one's too corny. Anyway, if you've got some better ideas, we would love to hear it. I think we're definitely going to have a few made up that says got stops and a few more that has what's in your portfolio. We're thinking about the others, but I'd certainly like to hear your thoughts on that because I'd really like to get some ideas. But they're going to be nice, comfortable shirts, and we're gonna do that. So with that, I'm going to throw it over to Don, and I want to talk about kind of this week, especially the last couple days. On CNBC yesterday, all you heard was it was all about NVIDIA the entire day. What is NVIDIA doing? And when you call Charles Schwab and you're waiting on hold, they had their little pre-recorded marketing review, and it's got a female voice, and all she said over and over was, because I had to call multiple times during the day, and I kept hearing, well, it's a one stock day today. It's only NVIDIA. It's a one stock day. The market doesn't care about anything else. So that was it. Now, I said the market is narrow, and it's getting narrow. So you got to be in the right place, or you may be in trouble. So the big question is, can NVIDIA reignite the rally and can continue, help the market continue this rally? Or is it not strong enough to hold up the whole rally? Hold up the whole stock market. So with that, Don, I set the table. Give us a little brief synopsis of the last few days, your thoughts on NVIDIA and the markets. Turn it over to you.
All right. So on Wednesday, the 15th, we had a gap up because the CPI data came in and it was in line or cooler than expected. There had been a lot of concern about what's going on with inflation. And you can see from coming off of the lows and regaining the 21 and the 50-day moving average, we were a bit extended there. And we went sideways for 4 additional days. So really it was about a 5-day consolidation. I had been talking on the videos that consolidations normally resolve in the direction of the primary trend. In this case, that would have been up. So let's go to a 15-minute chart here. Here was that gap up on CPI. And then we formed this tight consolidation with 52.83 at the bottom and 53.25 at the top. The NVIDIA earnings came out and we had a big gap up, and it sold off immediately, like within the first 5 minutes, 10 minutes, getting back below this key 53.25 level. So, and then we pulled back. We formed, the opening range, and we always model take a look at the opening range because that tells you who's in control for that day. If you're above the high of the opening range, the bulls are in control. If you're below the low, the bears are in control. And that can dictate whether we're adding or subtracting exposure for clients. So we have constant group discussions going on, and I mentioned to the guys that this 54.25 level was going to be very key. We needed to get back above that, or it's a failed breakout. We tested it several times, late morning, early afternoon, and then rolled over hard to the downside, including breaking that 52.83 level. So there's a saying in the market, from failed moves come fast moves in the opposite direction. And we're aware of this. And we took off a couple of things that we owned that weren't really making any progress, just an overall reduction in exposure, and put a hedge on to see. You get days like this, not frequently. We've had 4 of them over the last 9 months. I'm going to take a look at that in a second. But the question is, do you get further movement to the downside, or was it just a one-day situation and we get right back to the rally? What we're seeing today is what we expected yesterday with the gap up, that being all of the stocks that were tied to NVIDIA and this data center, AI data center build out theme. They started moving with NVIDIA yesterday, and by the end of the day, most of them gave up the gains. But today, they're absolutely rocking. And NVIDIA is up nicely, about 0.6%, but that's just in line with what the S&P is doing. So it took a day, but what we expected out of a lot of these AI data center names is what we're seeing today. So leaders are acting extremely well. The S&P 500 has regained the 8-day moving average and is back into that consolidation level. Now, I mentioned this has happened 4 times since last July. The first one was July 27th of last year. And when I say this has already happened, really what we're talking about is we're in a rally and we get a hard negative reversal to the downside. That happened on the 27th. We went sideways for a couple days and then rolled over, and that was the beginning of the correction, the 3 waves down correction of last July through the end of October. So that was the first one. The second one, so then at the beginning of November, we started rallying. We put in another similar day, meaning we're rallying, and then we have a harsh negative reversal near the highs. It happened again on 12/20. In this case, it was a one-day situation. We went higher, pulled back again after that, but held the key level, the 21-day moving average, and went and finished the rally again. So far we've got one failure, one that ended up resolving to the downside. It happened again on 3/8 right here. We're rallying higher. We open higher. We have a hard negative reversal to the downside. And that was just a one-day wonder, never even touched the 21-day moving average, and ended up resolving to the upside for another 3 weeks before we put in a top. And the fourth one was on 4/4, and that started this latest correction that where we put in a bottom under 5,000 a month ago, and now we started rallying since then. So we've got 2 that put in a short-term top. In fact, a multi-month top back last year. We had the one that put in the top for a month. We had 2 that continued to the upside. So far, and you can't draw the conclusion from one day's action, but this is exactly what the bulls want to see. We're back inside. We didn't make a lower low. Leading stocks are acting very well, and we're back inside this 15-minute this consolidation on the 15-minute chart. And the key level that we want to see now, because we regained that breakdown level, that means that we went from a failed breakout to a failed breakdown. And all that does is put us back right inside this big consolidation level. So we're again watching this 53.25 level. What happens if the S&P gets back up there? And now really we're back to watching that at the top level, and on the bottom, this 52.83-ish level, to see if we pull back and that holds again. So we've got a very nice, a percent trading range that we're back into, but fears of a melt to the downside this morning following through to the downside have not materialized. Yesterday, another part of the reason for the sell-off was we got some strong economic data that came out after 10 o'clock Eastern time. But rallying up and failing at that 53.25 level, and then the waterfall was obviously not something that we were looking for. It was sort of a negative expectation breaker. But today, the markets frequently repair themselves, and that's what it's doing right now. Now, last time this happened, we repaired for 5 days after negative reversal before we broke to the downside. So it's very possible. I mean, day one's great, but you need to see what happens day 2, day 3, day 4, and the lows of yesterday are a very critical level to monitor. Because if you continue further to the downside, then that cements the fact that this was a failed breakout and you're testing lower levels. And then we just start looking lower at what the other support levels are, the 21-day moving average, the 50-day moving average, monitor how leading stocks are doing along with the market indexes, and just position ourselves accordingly.
Yeah, no, it's so today when I look at us relative to the market, and this is just one day, obviously, we're doing far better because it is actually some specific stocks. Last year, indexing worked very well, and indexing was fine, and it was not as much as a stock pickers market if it was an indexers market. This year, it seems like it's all stock picking market. It seems like the indexes it's tougher, especially if you're not in the S&P or Nasdaq. I mean, if you're in the Dow or small caps or even international.
That's exactly right. Yeah,
Okay.
that's what's key is the right sectors and the right stocks. And tech is carrying the S&P and the Nasdaq 100, but for example, the Dow is only up 3.5% year to date. The Russell 2000 is up 1%. Equal weighted S&P 500 is up 5%, while now the S&P is up 11%.
Wow.
So it really is those big name. Nasdaq 100 is up almost 12% now. So it is being in the right names, the right sectors. This big AI and AI data center build out theme continues to be our focus. And then there are select retailers that we're in. Solar is making a big comeback. Some restaurants, and just that's the 21 over 21 list. Everybody on the team keeps their own personal list, so we know that we're not missing any of the leading stocks, and we'll stop out of what's not working and focus and feed more money into what is working. But this is really best case scenario for the bulls today after a day like yesterday. But then again, I could have said it was best case scenario for the bulls back in the beginning of April when we didn't have any further progress to the downside, but we did a week after that. So, we're always on alert. We take it day by day. We update it every night on our videos, show our portfolio, show the trades that we're making, and give a bullish and a bearish scenario so that we're ready for anything. And hopefully people that are paying attention and following us can learn from the mistakes that we've made throughout history, so they don't have to repeat them.
And we're backing off of a bunch of other people's mistakes that, over the last 100 years.
That's exactly right. Yeah. Well, yeah.
Books from Livermore all the way up to Bill O'Neill. And that's what I was talking about,
right.
The FTD, the follow-through day, when Don said, look, today is day one after the big sell-off yesterday, except for NVIDIA. You need day 2, day 3, day 4, because that's that FTD, that IBD follow-through day, that day 4 was so key that Bill O'Neill discovered that was how you determined whether the primary the uptrend had a better probability of continuation. And so that's why I was saying with Bill O'Neill, it doesn't matter whether it's May and selling May. It's if you get a follow through day, you take it regardless. That's also why I said even if it's a narrow market, as long as you're in the right narrow, it's okay. Now, that said, you still have to have a sell discipline for those things, or a hedge discipline, because one of two things normally happens in a very narrow market. Those stocks carry the rest of the market, and then you have a broadening breadth widens and more stocks do better, and the resumption continues, or finally the rest of the market will bring that narrow sector, those leading stocks, down. So we'll be watching closely on whether the breadth expands or contracts. That's the same thing earlier when I was talking about bond yields. The way that you tell with bond risk, bond prices, when the market perceives there's low risk, there's not a big spread between high yield or junk bonds and investment grade bonds or treasuries. When people are scared, that risk widens because there's fear that the high yield, the junk bonds will go bankrupt. They act more like growth stocks. They won't be able to pay their bills. So the spread widens. The risk is reflected in the yield spread. So in any event, you got to be watching all of those things to make sure that you stay out of harm's way or minimize harm's way. All right, Don, what do you got next? What does Connor have? By the way, Ted, Okay. Sorry, I was going to say real quick. Ted is actually taking the week off. He's actually in Hawaii. I hope he sends us a picture in his lace, his grass skirt, doing the dance with his lei. But I'm sorry, Don. Go ahead.
Yeah, you mentioned the O'Neill follow-through day. It was a classic day 4 follow-through day back on November 1st that got us back into the market after this 3 waves down sell-off last summer and fall. And then it was just we rode the wave, and then it was just a matter of this break of the 50-day moving average here, this big break that within 2 weeks off of the top, we were out of every one of our individual positions and just holding an index long. And that's kind of the way we do things. The typical pie chart advisor has emerging markets and international stocks and bonds and things that can drag down the return unless they're outperforming the S&P. And people say, well, what about home country bias? The S&P 500 gets 41% of its revenues from outside the United States. It's not all U.S. It's a global index. They're listed in the United States, but you can't say with getting 41% of your revenue outside of the United States that you have to be diversified into international stocks. There has been virtually zero dynamic breakthroughs from international companies, for one, because of the constant government keeping them under their thumb and all of the regulation over there. It's been U.S. tech companies. Now, granted,
Yep.
Novo Nordisk, of course, there's always going to want Taiwan Semiconductor, ASML.
Israel,
there are a few,
Israel is the one country that has some good research and development, and South Korea.
But the bulk of it is coming from the U.S. and it's companies that are in the S&P 500. So it's not just a domestic index, but the fact is that these other indexes haven't been able to beat it. And because of how big the weighting is in these big tech companies, it's going to be difficult for them to beat it. I know small cap value has historically outperformed, and it had a massive period of outperformance 25 years ago. Well, what good is that doing now if it's just barely keeping up with the S&P 500? So we keep that, the typical 60-40, we try to keep that close to 0.6 allocation. And then when the market's favorable, we add on risk and exposure. And that's how we get the outperformance during market uptrends. We'll pull back to just the S&P 500, or if it's the Dow, or if it's small caps or mid caps, just that core exposure until the market decides what it wants to do. It's decided that it wasn't going to go for any further down 4 weeks ago, and reignited back to the upside, and we re-engaged. Had another question yesterday. Was this the top? So far, it's not. We're back into this range. Again, it takes a while to play out, but as long as we're holding the lows of yesterday, the market's fine.
And I want to kind of put an exclamation point on what Don said. Don, if you could quickly, I don't know if you got it in your charts real quick, but you had that one chart where you've got the S&P, and then you're showing like international emerging markets and some of these small caps and whatever these other diversified mutual fund. Folks, here's the thing. If you're going to invest in emerging markets or international, the Europe and Japan and Asia or whatever, you need to be overcompensated. Those markets need to be better than the United States, or why take the extra risk? Because it's not just the return risk you have the currency translation risk when you bring it back to US dollars. So if you're not beating the S&P in an emerging market or in a European fund, there is no reason to be there, because you have enough diversification in an S&P fund. That's plenty of diversification. We call it De-WORSE-ification when you've got this total global, completely diversified thing. So even if you're doing broad sectors, you're doing an asset allocation model, you still need to look at the sectors within that model and try to stay in the strongest 40 or 50% of the sectors and not be in the weak sectors. You don't need emerging. You shouldn't have owned emerging markets or international for years now, because it's just been dragging down the American stuff. Okay. Likewise, 60-40 bond, the balanced fund. 2022 was the worst year ever for both bonds and the balanced fund. It blew away that adage that, oh, the 60-40, it acts as a balance. The bonds act as a balance and smooths it out. It does sometimes, but there are time periods that stocks are as dangerous or as risky as tech stocks. The risk profile of investments changes over time. See, you've been told all your life it's all about your risk tolerance. Here at Revere, we're telling you it's about the risk in the sector, the stock, the overall market, the sector, and the stock itself. And that's as important or more important than your risk tolerance. So even if you tell me you're really aggressive, if you came in with Tesla and Tesla's crashing, I'm selling Tesla because it's a dumb thing to own Tesla while it's going down. Leading stocks on average fall 69% from the top in the next bear market. Tesla was the stock to own in 2021. In 2022, it lost 69% of its value. And just as a couple weeks ago, it was the worst performing stock in the S&P 500. I don't know if it still is. It's been heating up a little bit lately, but it was getting clobbered. Oh, thanks. So that is the stock. That is the chart that Don is showing. And those are that EEM is emerging markets. The BNDW is a total bond fund. TLT is safe treasuries. And look how much better the S&P is at the top. That's plenty of diversification. Now, again, you want to sell discipline because for some kind of rule, it could be a longer term sell discipline, the 200-day moving average or the 100-day. But all I'm saying is because at some point, the S&P will also fall out of favor. But even in 2020, you needed a sell discipline for bonds. In 2022, excuse me. So everything needs to have a sell discipline. All right, Don, go ahead. Sorry, I just wanted to put an because you made such a good point. I wanted to make sure that we drove that home.
Yeah, sounds good. So let's turn it over to Connor. He's got a couple of charts we're going to take a look at. Take it away, Connor.
Yep.
Got your first
yeah. So just gonna do a segment on market breadth and sentiment. So first thing that I wanted to talk about, I'm not going to show the picture, but so the sentiment readings that we like to follow, the AAII bulls bears, and so bulls ticked back up to 47% from 41% last week. And then bears also ticked up as well, 23% to 26%. So just something to watch. Pretty in the, I mean, more bulls than bears, but when the market's trending up, you expect that. And then the NAM exposure index. Sorry, go ahead.
Sorry, just real quick. I read a study. The time that you start to get really concerned is this: when you take the number of bulls, subtract the number of bears, and if that number is over 32, that is kind of correlated to market top. So you need to have like a ton of bulls and very few bears, and you subtract the percentages, and if that equals 32, in this case it's 21, not anything to be concerned about, even though that is historically a high number of bulls. So just a little anecdote, and it's something that I keep tucked away.
Thanks, Don. Always something. And then, so the NAM exposure index, this is what active exposure level of active managers. That's back up to 94% from 89 last week. And just keep an eye on when this gets over 100. Sometimes the market tends to pull back a little bit when these readings get above 100. But in a strong market, you expect these numbers to be higher. So you don't always want to be a contrarian on these. You have to know how to view it in certain markets. So I got 3 different breadth charts and some conflicting signals a little bit. So the NASI, this is arguably one of our favorites to gauge a tradable rally, and this is trending to the upside above those moving averages. And one thing to note is that the RSI is in overbought, but when you look historically, that can stay overbought for quite some time. So that's given us the thumbs up, showing the market's healthy. And then if you go to the next chart, Don. And then this is the S&P chart with new highs. And one sec, see that. Did it switch? There we go.
Yep.
So yeah, so this is the chart of the S&P 500 with new highs. And yesterday on that reversal day, the new lows there wasn't many new lows, and that's what you want to see. And then this recent rally that we've been having, it's been confirmed by strong new highs, and it's just telling another thing the market's telling us it's strong. Now we would have been a little bit more concerned if the new lows really ramped up yesterday on that pullback, but it was a very small blimp showing that buyers are still in control. And then the last one is, it's a NASDAQ chart with, and then below I have percent of stocks above the 20, 50, 150, and 200-day moving average. And one minor bearish divergence I am seeing here is the NASDAQ made new highs yesterday, but the percent of stocks above the 20, 50, 150, and 200-day actually made lower highs. So that's something to keep an eye out for. It's just some of the bigger stocks are dominating the market right now, and that can be expected. So that's just something to keep an eye out. And if those percent of stocks above those moving averages really start to deteriorate quicker, that could be an issue. But for now, you just got to skate to where the puck's at. And if people are going into NVIDIA, there's no reason why we can't be in there as well. So that's a little quick segment on breadth and little market update. I'll cover more of that stuff in depth on the weekend video as well, like we've been doing.
I like the hockey. I like the sports analogy, especially since the Dallas Dallas Stars are hopefully going to the Stanley Cup. But so what you're looking at, Connor, kind of confirms what I was talking about in the beginning about how the market's making higher highs, but it's really it's a few stocks, and you're seeing more stocks drop off and struggling. Is that correct?
Yeah, that's what it was showing. Yeah, for the NASDAQ composite.
Right.
And anytime you see small caps lagging, which is what we've seen lately, you're going to see that, because it treats the biggest stock in the exchange the same as the smallest stock in the exchange. And it's just, obviously there's more small caps. It's not called the S&P 2000 for big caps. It's the Russell 2000 for small caps. And when those are lagging, that just means more smaller stocks are underperforming. And we have been on a relative basis. Always look at the relative strength line. Small caps have been lagging for a total of 3 weeks. So you're just going to see breadth deteriorate. But we don't. That's a secondary indicator. That's what's important. It's the price and volume of the big indexes and the leading stocks within the leading sectors within those indexes that we pay most of our attention to.
Yeah, and so with what Don just said, even if you're doing some kind of asset allocation, not that we're big advocates of it, in what Don was saying is if you're monitoring that, you could actually trim, even if you're going to have some small cap exposure, some, not much, some, you would trim down and you would allocate more to the S&P and have a lot less small cap. They call that being overweight and underweight when you're doing that asset allocation. So that's why it's important, folks. You can actually enhance what you're doing, and even if the return is the same, if the drawdowns are far less, if your volatility is a lot less. So if I can make the same return or a similar return as the S&P, but not go down, but go down half as much, that's still a big win. That is a win. So it's all about risk management. So we manage risk first, and then we let the returns take care of themselves. Don, do you have anything else you want to put a cherry on top, or are you good?
No, I think we're good. The lows of yesterday are critical, and best case scenario for the bulls is a break back above 53.25 that holds in the S&P 500.
All right, folks, listen, remember it's Memorial Day weekend. Remember those who sacrificed all so we could have the freedom of speech and the right to do what we want and not be told what to do, like in a lot of countries. And so just remember that this weekend. And remember, we need your best t-shirt idea. You got anything better than Got Stops or what's in your portfolio? Listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. They can put in their name and email address. Don's Daily Market Insight videos will go right in their inbox. Every day the market's open, and they'll get this podcast every Saturday morning when it's sent out. Or if you go to YouTube and just search for Revere Asset, just Revere Asset, and you can subscribe. Zach will actually have this posted probably by 1 o'clock Central Time Friday afternoon, because the stock nerds who eat this stuff up, they want it before the market close on Friday. You'll get all of our stuff a little bit quicker. And you can always call us old school at 855-REAL-WEALTH. Folks, have a safe and happy 3-day weekend, and we'll talk to you next week on Your Money. Not their money, your money.
Because it's not how much you make in the markets, it's how much of that you can keep.